Welcome to the Explainer. Today we're jumping into the world of accounting, not just as a bunch of rules, but as a system built on integrity. We're going to look at what happens when the numbers don't quite line up and the principles that are there to make sure they tell a true story. So in this Explainer, we'll get into how businesses find, fix, and frame their financial information. It's all about turning those potential slip-ups into a system of financial trust that, everyone can actually rely on. All right, first up, accounting's oops moment. So where do things even start to go wrong? Let's begin by looking at the two basic kinds of mistakes that can sneak into a company's books. Some mistakes are super obvious. They throw off the trial balance, which is just that check to make sure total debits equal total credits. But the really tricky ones, they're these invisible errors. The books look perfectly balanced, but there's a mistake hiding in plain sight. These are the ones that, they require some real detective work. Okay, on to our next section, fixing the financial record. So once we know these hidden errors are out there, how in the world do we hunt them down and actually fix them? Yeah, let's put on our detective hats for this one. So it turns out there are 6 main types of these sneaky, invisible errors. They range from completely forgetting to record something, that's an error of omission, to just flat out entering the wrong amount in the first place. They don't mess with the trial balance, which makes them so hard to spot without a really careful review. They're like the financial version of a typo that spell check just completely misses. All right, let's zoom in on one of these, the error of principle. Now, this one is pretty fascinating, honestly, because it's not about bad math. It's about, misunderstanding the rules. You debit and credit the right amounts, but you put them in fundamentally wrong categories. And this slide lays out the fix perfectly. So a business spent $45 on car repairs. That's just a day-to-day expense. But they mistakenly added it to the car's value, treating it like an asset. The correction is a simple 2-step journal entry. First, you debit the correct motor vehicle repairs account to finally record the expense. And then second, you credit the motor vehicle asset account to take away the amount that was added by mistake. And just like that, the books are balanced again, and more importantly, they're actually accurate. Okay, another really common one you'll see is the error of commission. In this case, the amount is right and the type of account is right, but it gets assigned to the wrong person or company. Think of it like this. You're sending a package to the right street, but you've got the wrong house number. Okay, so in this example, a sale made to M. White was accidentally debited to S. White's account. To fix this, it's pretty straightforward. You just credit S. White's account to, cancel out the mistake, and then you go ahead and correctly debit M. White's account. It sounds simple, but it is absolutely crucial for keeping accurate customer records. Fixing errors is all reactive, right? It's cleaning up a mess. But good accounting, that's proactive. It's about setting up a system of policies to stop the mistakes from happening in the first place. Kind of like setting the rules of the road before you even start driving. And this right here is a really crucial distinction to make. So you've got principles. Think of these as the universal laws of accounting. They apply to literally everyone. Then you have policies. And these are the specific ways a company decides to apply those rules inside their own business. For example, how they choose to calculate the depreciation on their assets. And really, the whole point of choosing these policies so carefully is to create financial statements that are genuinely useful. We're not just crunching numbers for the sake of it. We're trying to tell an honest, fair story about the company's financial health. Okay, moving on to section 4, the 4 pillars of trust. So how do we know if that financial story is a good one? How do we actually measure the quality of this information? Well, it all comes down to 4 key objectives, and you can think of these as the pillars of financial integrity. And those 4 pillars are comparability, relevance, reliability, and understandability. When you put them all together, they make sure that financial info isn't just a jumble of numbers. It becomes a trustworthy story that anyone, from investors to managers, can actually use to make decisions. Okay, so first up, we have comparability. And this one is all about consistency. It's what lets us compare apples to apples, whether we're looking at how one company did over several years or how it's stacking up against a competitor in the same industry. And this is the key question that comparability is really asking. Without it, you can't spot trends, you can't make any meaningful judgments. It's what turns a single financial snapshot into like a coherent movie of the company's journey. Next up, we've got relevance. Basically, this means the information has to matter, and it has to get to you in time to actually make a difference. Financial data from 5 years ago, it might be interesting, but it's not going to be very helpful for making a decision today. And at the end of the day, relevant information is what empowers us. It should help us figure out how well the managers are actually running the business, giving investors and other stakeholders the tools they need to hold leadership accountable. Okay, our third pillar is reliability, and this one is all about trust. Plain and simple, can you actually count on the numbers? Reliable information is a faithful, honest picture of what really happened, and it's free from bias or any major errors. You want a great test for reliability? Ask this. Could an independent auditor look at the exact same data and come to the exact same conclusion? That verifiability, that is the absolute bedrock of trust in any financial report. Period. All right, let's bring it all home with our final section, the final balance. Because, in the real world, these pillars we've been talking about, they're not always in perfect harmony. In fact, there's this built-in tension right at the heart of financial reporting. And here it is, the core dilemma for pretty much every accountant. There is almost always a trade-off between relevance and reliability. You just can't always have both at the same time. And this really highlights that constant balancing act. I mean, what's better? To be fast but maybe a little uncertain, or to be totally certain but late? If you rush to get information out there, it's timely, it's relevant, for sure, but it might not be fully verified, so it's not as reliable. On the other hand, if you wait until every single detail is confirmed, yeah, it's reliable, but it might be so old that it's useless for making decisions anymore. So, we're going to leave you with this final question to think about. The principles we've just talked about, they aren't just some abstract rules in a textbook. They are the absolute foundation of financial analysis. I mean, without them, all we have is a list of numbers. But with them, we have a story we can trust, a story we can learn from, and a story we can use to build a better future.